Good afternoon, everyone. My name is Paul Hill, and I'm delighted today to have with me Clive Beattie, Acting CEO and Group CFO of OnTheMarket.com. That's ticker OTMP, a UK leading residential property portal. Now, in terms of order of play, Clive is going to take us through a presentation, first of all. Then we're going to pull some questions from everyone from the floor. And if you haven't yet had an opportunity to submit your questions, then please do so in the bottom right-hand box. So over to you, Clive.
Thank you very much, Paul, and thank you all for joining. So as Paul says, I'll give a brief presentation, but then hopefully move quite quickly into the questions and answers, and that'll be the more important part. But looking at On the Market, we are a portal, UK property portal, developed back in 2014 and backed by agents, developed by agents. So it was built by them and still majority owned by estate agents. We list properties for sale on behalf of something like 14,000 advertisers now, and an advertiser will be an agency branch or indeed a new home development where we've started to list new homes as well. We're one of the largest UK portals. The other two big ones you'll be familiar with are Rightmove and Zoopla. And we act in a market which has something like 18,500 agent branches in it. We came to the market very much as a disruptor, and we sought to offer listing services that were at very competitive and sustainably fair pricing to our agent advertisers. And one of the key differentiators that being our strong relationship, our strong alignment with agents gives us is something called new and exclusive, which is a key differentiator between us and the other portals. And it's where we get new properties coming to our portal 24 hours or more before they're seen on any other portal. And that generates very strong leads back to our agents, because the most interested property seekers in the consumer audience look on our site to get first viewing of those new properties and contact the agents. And so that works very well for both sides. We came to the AIM market in 2018. I mentioned above, though, we still have something like 65% of our shares in agent ownership. Very spread, over 3,000 firms, over 6,000 branches represented. They're all, relatively small holdings, but a very strong alignment between a broad part of the agency market and ourselves. When we came to AIM, we did a 30 million capital raising through a placing, and that's basically given us the funding to pursue a transformational growth strategy. We've grown the property listings through offering agents, new agents joining us free of charge contracts. And we've grown consumer traffic, obviously, through marketing spend using those placing processes. We've also started to diversify the portfolio of the products and services we offer. We made a small investment in a business called Glanty, which has a product called TechLet. It's an online estate and lettings platform that simplifies the processes, takes out administrative cost for agents. And so that's the first move of what we see as a medium-term future in providing additional products and services, not just the core listing service. And in terms of how the portal is now performing, you may have seen recently we announced July just gone. The estate agent markets are very busy at the moment. We had over 2 million leads back to our agents, a record for us in July, over 148 leads per advertiser on average. It's a very strong model, and I think that shows that the portal is now working, is delivering value back to our customers, and hopefully we can now capitalize on that and look to convert our free of charge listings onto paying customers now that we are delivering value for money. Just turning to our strategy, look, clearly our aim is to be the number one portal of choice for both agents and consumers. But this lays out how we plan to do that. If I look first on the left-hand side at the marketing, clearly we want to continue to improve our leads, generate more leads, and increasingly better quality of leads for our agents. And therefore, those who are either still free or paying discounted rates will increasingly get more and more value from what we provide back to them, and that will enable us to increasingly get everyone onto a full tariff contract. I've touched above, that we are still seeing record leads at the moment, and that's a great sign as we come out of COVID. The markets are hot because of the backlog of properties that built up, stamp duty relief and other factors. But the fact that we are doing so strongly in these markets is very encouraging. If we look at our new and exclusive offering, as I say, that brings us, as I said, we think the best leads to our site, people who are most interested in getting a property, and therefore the ones that the agents most want to hear from and get in touch with. And we're going to increasingly push that to see if we can get greater numbers of new and exclusive property and differentiate ourselves in that way. And finally, new homes developers. They're a new area of the market that we've been targeting. We listed our first new homes developers back in September 19. That was Barratt Developments. And since then, we've had a number of others sign up, Persimmon amongst others. And we've now got over around 1,200 developments listed on the site. So again, an area that's growing very strongly for us. And we see a positive contribution from that as we go forward. The second side, on the right-hand side, is technology. We're continually looking to enhance both the functionality and the ease of use of the portal, both how the user interface is for the consumer, but also the products and services available both to consumers and to agents. One of the things we did in COVID was introduce a new filter so consumers could look at properties that had video tours associated with them, because obviously they were proving very popular during lockdown to look at those properties above ones with just static photos. So those sorts of enhancements we're continually doing. But as I mentioned, with things like TechLet, we see the platform as a very strong platform in the medium term for a whole range of products and services that are associated with house moves. Looking at some of our key figures, KPIs and financials, our financial year end is January, and looking at January 20 numbers, I've set out some of those on the slides. Our focus has been on driving scale and investing in the proposition. So we've seen a significant increase in the branches and advertisers in total who are listing on the site. And that, of course, gives us a greater content. So when the consumer comes benefiting from our marketing spend and our increasing brand awareness, they're much more engaged with the portal because they can see a far greater range of properties that they're interested in looking at. And so we're seeing a much higher repeat visit from our consumer traffic, which is very good. In the year, revenue increased 32%. That reflects the fact that we started the conversion of the people who had initially joined during 2018 on free contracts. Those free contracts ran about a year and started to convert as we go into 2019 and through the whole of the year. Now that all came to an end in COVID, but that was behind the 32% jump. It's worth flagging that, of course, because we're converting people as we went through the year, the half year on half year performance is even stronger. A lot of the growth was in the second half of the year. So revenues in half two were 10.8 versus 8 million in the first half. And that meant that although we made an adjusted EBITDA loss still of 7 million, 5.6 of that was in the first half, 1.5 in the second half. So actually the performance was improving month on month through the year. And despite the uncertainty of COVID, and that has obviously put things on hold for a period, nevertheless, we're confident that we can get back into the market as things are heating up now and look to pick up on that momentum again going forward. So we do expect a short-term impact on revenues through the COVID and through the discounts we've given, but we've taken a number of steps, predominantly reducing staff costs and reducing marketing spend to conserve our cash and make sure that we see through the COVID crisis and get back out the other side to pick up again. Finally, on the investment case, just the key points I think to highlight. We're actually a very well placed in our market with a very competitive offering, and the market itself is growing. We've seen a very big structural shift to online advertising, and that really continues, although a lot of it has happened, but there's a continuing shift of some of the spend in other channels is still going online. So the marketplace is a strong one for us to be in. We think importantly, we've got this very strong agent ownership, and that sets us apart. Our shareholders are our customers, but we think that gives a very strong alignment. We've talked about the ways they can help us through new and exclusive. So I think actually working together gives us the best prospects of flourishing in the future. And many of those agents who support us, we've got long-term agreements with. A lot of our revenues are contracted out till Feb 23 and beyond, some through into 24. So we have a strong underpin of a revenue base, and we are now looking to build on that by encouraging those agents who initially joined us for free to start paying potentially as shareholders as well and join those already with us. And thirdly, as I say, that's the core for us. But in terms of progress, at the end of January, we had something around 8,000 branches under paying contract. Actually, now that's over 9,000, and clearly we want that to continue increasing. The increase definitely slowed because of COVID, but hopefully picking up now, particularly with the strong leads we're producing, the strong return to our shareholders, we'll see that pick up as we go forward, and that's the next core task for us. We'll then continue to explore new products and services. Those are likely to be a more medium term in terms of a financial contribution to the business or a material one, but nevertheless an important part of differentiating our services as we go forward. And then finally, I think we've got an excellent team from the board down, a very strong board, but also a great team, all my colleagues who've worked tirelessly during these very testing times of COVID. And I think that stands us in very good stead. Ultimately, you're only as good as your people, and I think we've got excellent people. So that is a quick overview. As I say, I don't want to take too long because I'm very keen to be able to take the time to answer any questions you have. So with that, Paul, I'll hand back to you.
Thanks very much, Clive. Can you just quickly take us through how you see the market at the moment? I mean, there's been a very strong bounce in house transactions and prices. I think they've all been consistent with Rightmove and Nationwide and the Halifax. And how's that feeding through to the coalface for your sort of like advertisers? And also, what's the visibility going forward? How long is this likely to last? Admittedly, that's a difficult question, but just sort of like finger in the air.
Yeah, well, you're absolutely right. The markets are very busy, and there are possibly three factors, I think, behind that. The first is obviously when the lockdown was at its most extreme from 23rd March to about 11th of May, when no business could be done at all, agents couldn't leave their homes. Clearly, that built a backlog up of transactions waiting to happen. So that backlog concertinaed over time and has now all come to the market, and therefore there's a lot of that in the current numbers of transactions and the busyness of estate agents. But on top of that, I think COVID did cause people to reflect on their home choices and where they lived. And we undoubtedly are seeing a large number of searches now, a much greater proportion of searches out of towns, looking at places that have gardens, home studies for home working. So I think there has been an element of shift in people's views on what they want as a property to live in because of the COVID pandemic. And then the third factor is probably the stamp duty relief that the Chancellor introduced, which has brought more. I think that day we probably saw our highest ever day for viewings and traffic onto the site. So that has also brought some heat into the market. So I think short term, agents are telling us that they are experiencing the busiest months they've ever had. So I think very busy in the short term, and that augurs well. You're right, I think, to flag, the uncertainty in the future. There are increasingly, as we get nearer the date, there's speculation about what will happen when the furlough scheme ends, what will happen with unemployment and macroeconomic conditions. And clearly that can be a concern, and that could impact on the robustness of the market as we go forward in time. But my hope is that clearly it won't be as severe as it is feared it could be. But also I think as long as we can avoid the full lockdowns, there are always transactions happening in the property markets. We've been through crashes before 2008, and still transactions happen. As long as things are happening, agents can do business, they can earn money, and that is what I would hope. But clearly, if things go back to a full lockdown, that is when there's going to be difficult times ahead.
And who is the sort of like the key rung in the sort of property ladder? When you get these chains, one of the sort of like the things that people talk about is first-time buyers, the importance of these guys. Now, during the lockdowns, most of them haven't been able to, spend any money at all at bars and holidays, etc. So they've actually been saving a massive amount of money. Now, on top of that, you've got the government giving this sort of window of zero stamp duty, which is likely to pull forward demand at least until March the 31st when it expires, and it will probably be extended on top of that. If those guys are actually active in the market, presumably that provides the foundation for the rest of the chain to be able to move, doesn't it? So just for flagging for investors, presumably that's the most important piece of the puzzle.
It's definitely a very important piece because, as you say, it unlocks the rest. It enables people to move up and trade up in houses and move on. Actually, because they had benefits on stamp duty and things anyway, and for many places in the country, the stamp duty isn't a big issue. So more important, I think, to first-time buyers is mortgages, what mortgages they can get. And actually, probably before COVID, they were at 95% loan to value. Perhaps those dropped to about 85%. They're probably more around 90%, some of the offerings now. But I think its access to finance is critical. We need to ensure there's access to finance at sensible levels, because obviously, having to pay another 5 or 10% of the price in a deposit is a very hard thing to find for the price of houses now for a first-time buyer. So I think the first-time buyer schemes are key to keeping the market afloat. We've seen various things and schemes by government, but certainly that's a key one that they should focus on and make sure that first-time buyers can continue to afford to move into housing.
Okay, and then overlaid on that, just the actual competitive position of On the Market. I did notice on the Rightmove's recent results, which was issued only about a week or 2 weeks ago, and people can get this if they want to, which is just downloadable. But they've got quite an interesting chart on page 25 talking about market shares. And it seems as though On the Market is the only one increasing their market share according to the charts. Can you just take us through whether, one, that's your belief, and two, how's that actually, how's that been achieved, the sort of like competitive differentiation for On the Market versus the sort of like prime location, and particularly Zupa, I think, has decreased quite a lot, actually.
Well, I don't. Although I'm sure I've seen the slide, I don't have it in front of me to reference. But basically, if I talk about what's happening, I mean, we certainly have seen our advertising base growing quite strongly, and as I say, up to about 14,000 advertisers now. And for those who have followed us for a bit, you may remember when we came to market, to the AIM market in February 18, we're at about 5,500. We've seen some dramatic and rapid growth in the last couple of years. And clearly growing from a small point, which the others wouldn't have had that advantage. They were bigger to start with. Zupa is quite hard to say because obviously they're now a private company and they don't publish figures in the same way. But our sense is, that we would be pretty getting close to the size of Zoopla. Rightmove are undoubtedly still the biggest, but Rightmove have started to see agent branches come off them. We've recently announced that our exclusive branches with us has almost doubled in the year on year to about 1,600 or so now. Rightmove in its latest figures, its numbers have come down. It used to be over 17,500 branches at one point, but it's now below 16,000. So there has been a bit of movement in the two. I mean, from our point of view, we are more focused on what we can do. We need to offer the right number and the right quality of leads to advertisers at the right price, that they get a strong value, and therefore they both want to be on the market, but also we can charge them a fair fee at tariff, and they will be willing to pay that because of the value we give back. And I think if we can focus on that, and then over time increasingly offer other products and services that differentiate us, that's our job, and the others will do whatever they do.
And how is the 24-hour exclusivity period going with actual consumers? Because I mean, if I was looking for a house, then presumably, you guys would be the first one I would look for, because it would draw me into the website to see what was actually there that would be less sort of like hot in the market for other buyers.
Yeah, I mean, that's very much what we find with it, and why we work with our agents to help us provide that. I think people often say, well, surely the vendor was losing out, but actually no. I think if you're a vendor, the way it works is, while the property is exclusively with us before it goes on the others, it comes to the top of the search list. You get an enhanced presentation, you get more photos, a better presentation. So all that launches it more effectively. All the emails, the millions and millions of emails we send out to those people looking for those types of properties, they will see it at the top of the email and can click straight through to the agent. But of course, a day or two later, if people aren't looking on our site, and I think increasingly they are, but if they're not, they'll still see it on Rightmove. So the seller will still expose it to the market. And whilst most transactions don't happen within a day, the advantage of coming to our site to see it first, I think, as a buyer, is actually, if it is the house you want, it's the one you want. You don't want to be 48 hours behind someone else contacting the agent, arranging a viewing, potentially making an offer. All those things can happen quite quickly. And I don't think it disadvantages the vendor, because it's up to them if they accept the offer. If you offer full price and they take it, great. If you offer a discount, they may wait, and a couple of days later, someone from Rightmove may offer full price. So actually, the way it works, really, I think it gives an advantage to those consumers who are looking on our site, who are able to get first mover advantage on those properties. And we have thousands of those properties every month. So.
And sort of like the value that On the Market gives its agencies, am I right in thinking that the price per month is around about £300 or 280 or something of that sort of order? Is it?
That's the sort of figure we give as an average. So the way we price is it varies a bit by geography. So central London costs more than Yorkshire, and it varies by scale. So larger firms with many branches get a discount per branch. Plus it varies. If you're lettings only, then you tend to pay about half the rate of a sales and lettings. So there are variations, and that's how we come up with the 300, which takes all that into account. But yes, if we had everyone on full tariff, that would be about the rate on average.
And then, so am I correct in thinking there's about 134 leads per advertiser per month? And so we're talking of just the maths. It works out at less than £3 per lead each month. I mean, that seems terrific value.
Yeah, and I think, if we look at leads and value in that way, because we charge a lot less than than the others, but predominantly Rightmove. I mean, Rightmove certainly does more leads than us. It's got more stock, it does more leads, but actually it charges a lot more as well. And so when you look at leads per pound, as you've just done, I think you'll find we're incredibly good value.
Okay, and then just in the talk, can you just talk through the actual listing fee discount? Because obviously it's continued until the end of September, but given the actual buoyancy of the property market, presumably everybody in the sector, Rightmove, Zoopla, yourselves, won't need to carry on with that because the agencies are doing so well.
Well, look, clearly, we hope that the agencies do well, and we hope we do well. I mean, we haven't made a firm commitment one way or the other. We've always said we'll monitor, but clearly, as you rightly say, the markets are very busy now. It takes a little while for cash to flow into the agents' pockets, but I think that's started to happen. It happens more quickly on the lettings business, obviously, because they take less time to transact through. But I think we're now seeing, if we look at our figures for sold subject to contracts, that's been increasing week on week for a number of weeks now. So things are happening, and it still looks very positive in the agency market. So that is a good backdrop. I mean, obviously, we can't afford to give discounts forever. We don't have the depth of pockets. People may remember coming into COVID, we were still a loss-making business. So, we have to look after our own business on behalf of our customers as well. And we've done that to date by offering a discount, but also by reducing our costs. But actually, it's not in anyone's interest that we run our costs without marketing long term. We need to get back to both the full rate for those who have already joined us and increasing those numbers of people paying those full rates.
Okay, and then sort of other revenue streams. I've noticed the UK house builders now sort of like breaking ground on some of even their newer sites like Persimmon a couple of weeks ago. How do you see that sort of factoring in? Because these guys are absolutely trying to sell as many properties as they can do in a fast amount of time.
Look, I think that's going to be increasingly important to us, as you say, both for that, but also they're very important in the point you raised earlier. They're very important in the first-time buyer markets. So no, that's a key area, and we're very encouraged actually, because as I mentioned earlier, we only launched that in September 19, but we're already up to about 1,200 developments, some of the very biggest with us, Barratt, Persimmon, and so on, and obviously looking to expand that further. And that segment has been a material segment of revenue for the established portals. We've been working the same way as we did with agents. So really, we need to get them on board, demonstrate the value we can provide, and then monetize that as we did with agents. But I think increasingly, we'd like to see that be a material contribution to our revenues.
Okay, and then just on the sales, the sort of the way it shapes up for 2021 in terms of sort of like splits, etc. We've obviously got the discounts in the first half. Are we going to see a sort of like a first half, second half weighting, and presumably we'll also have more fee paying, or should we say less of the sort of the free agencies as well factored into the second half?
Yeah, I mean, like many, we haven't got guidance out there because of the uncertainty, but I think it's fair enough, the points you make, to say that we're still discounting now actually, so some of the discount has slipped into our second half. Our half year end of July. But the majority of discounts, as you rightly say, will, assuming we don't need to continue them for agents, will be in the first half. And also, we have just started re-engaging with the agents on the free of charge to say to them, now is the time to start paying, and offering them a choice of contracts, paying contracts. So I think, in the broader picture, you're right. The discounts, if we don't have to extend further, will be weighted to the first half, and the growth in revenues will be weighted to the second half.
Okay, and then if you don't, just apologies, I want to ask a bit of a cheeky question here in terms of sort of like, you've got 14,000 advertisers, which I think works out around about 75, so about 75% of the market share. And you've mentioned in your presentation, you had 9,000 paying agencies. So by default, you have 5,000 who are non-paying at the moment, is free. How many would you like to convert of those 5,000 now by the end of the year?
So just to correct a couple of things, because the 14,000 advertisers includes new home developments, of which, as I say, there's over 1,200. So actually, the numbers of free of charge agents is more around 3,000 rather than 5,000 at the moment. And look, practically speaking, it takes time to have the various meetings to convert them. It's not a process of just sending an email and that's that. So it is going to take a bit of time. And actually, in all honesty, some of them, some will be getting a better service than others. So some might want to look at just going on to discounted rates. Others might be encouraged by the fact we can offer them shares to join as shareholders and join on the full tariff and benefit from being a shareholder. There's a range of ways we're engaging with those agents. But ultimately, I think it's only fair to all our agents. We've got many thousands paying full tariff. Clearly you can't offer frees into perpetuity. You can't offer discounts into perpetuity. We need to continue to improve our return to those people, continue to improve the number and quality of leads. But as we do that, in recognition of that, we'd hope that they would continue to choose to support us and to pay a reasonable price for doing so.
And what would be the sort of the indicative run rate of those 3,000? Would it be correct in thinking sort of like if there's 3,000 of them doing it 300 a month, we're talking of roughly around about, well, just doing the maths, that sort of works out at 9 million, 10 million a year on an annualized run rate.
Yeah, that tariff, absolutely. So, if the other way I break down the numbers is, and I've said this to others, we've broadly got 6,000 or so on paying full tariff currently, 3,000 or so on a discounted rate of some number, and 3,000 or so on free in broad terms. If you just looked at using the £300 as an average across that, if we got all the ones currently paying something, if those 9,000 paid us tariff, we'd be on about 33 million of revenue. If the 12,500 roughly that are on us all paid us full tariff, would be on about 45 million of revenues. So you can see the opportunity for, last year, our year to Jan 20, our revenues were 19 million. So we've got large scope for increasing our revenues. Our costs last year were about 28 million. So very quickly, we could become a strong, powerful business if the agents choose to support us, if we can deliver them value, and if they'll choose to support us in paying contracts. I don't think we'll get them all onto full tariff immediately. I think we'll continue to see people who prefer the shorter term discounted offers. There is still some uncertainty in the agency community over, the longer term impact of COVID, what might happen in the coming months. But, I don't think this is an overnight thing, but the potential is there for a very material growth in our revenues.
And then just on the cash side, what was really caught my eye was that you were cash positive in June, despite all the discounts, and you made it was an extra, and also I think you closed June with a net cash of 9.4 million versus January at 8.7. So on the cash side, it looks as though it's been a fairly mild COVID flu as much as anything, which seems incredible.
Yeah, I wouldn't read everything into 1 month, because obviously you do have working capital VAT type movements month on month, so it's dangerous to look at 1 month. But the broad position is correct. When COVID broke, we thought the right thing to do was to try and help the agents who are our customers who couldn't do business. So that was why we did the discount in the first place. But clearly, for a business going into COVID that was loss making, to then discount your revenues and know that actually you'd have to stop converting people from free, we had no intention of going asking people to start paying during that time either. So we did take a hit on our revenues, and we had to compensate, because clearly we're not the biggest company with the deepest pockets. We had to look after our own cash. So we've done that by reducing our marketing significantly. We've spent very little on marketing. Actually, you may see, hopefully a lot of the people on this call have seen that we're back on TV, but even our current TV advertising was pre-spent. You have to book in advance and pay in advance. And that was all paid for pre-COVID, that we've managed to defer the use of. So actually, even that isn't cash out of the business currently. It's cash that left the business much earlier in the year. So we have looked to take those actions. We furloughed a number of our staff, which is unfortunate, but we had to do that. We also, for those staff that remained, and the vast majority, took a pay waiver, voluntary pay waiver. There's been a range of ways we've looked after our cash. What we need to do now is, and what we hope to do is, as our revenues hopefully pick up again, as discounts unwind, as new people start to convert to paying contracts, we'll start to see in the first instance our costs go up, because we will clearly want to market again on behalf of our customers. But the costs will cap out. I indicated last year they were about 28. So the costs will come to a stop, and if our revenue growth can continue, then that's when we start to have free cash flow and profitable business.
And you've got a lot of levers to pull, as well as, I guess, as if we did actually have in the unlikely scenario, a second wave or a second lockdown, which personally I don't believe anyway, but if we did, then presumably, the marketing would be, it's where you flex it, isn't it? The marketing and sales.
It is. Look, we'd have to do the same actions as we took this time. We'd have to see what support was available for government. I mean, if we get that worst case, have they still got the funds to support everyone in the same way? But look, hopefully we won't be in that scenario. As I say, if it's, I can imagine that things could be difficult at a macroeconomic level, but as long as agents are able to get out there and do some level of business, then hopefully we can all tighten our belts and get through until, people may not remember now. I mean, COVID is hard to remember what the world was like before, but actually we'd gone through what was called the Boris bounce and the Brexit uncertainty. Actually, the agency markets were looking very healthy in January, February, early March of this year. And most agents at that point might well have said they were looking forward to a much better 2020 than 2019. Now, that won't have come to pass for obvious reasons. But I think there is a hope that actually, fundamentally, there is more demand than supply for housing in the UK. That ultimately should lead to positive, buoyant agency markets, and hopefully those will return soon.
And then just come finally, in terms of the appointment for a new CEO, how is that progressing? I know it was obviously put a bit on hold because it was impossible to interview anybody, but...
Yeah, so I mean, one would have hoped that without COVID, we'd have been done and dusted by now. All I can say is, I mean, actually, everyone here, the board wants to get that sorted as soon as possible, and that's the process. I mean, clearly, one doesn't want to rush and come up with the wrong decisions. So, one needs to take one's time and get the right decisions and the right person to deliver the future growth for the business and its shareholders and customers. So that's the process. All I can say is, we'll hopefully, as quickly as possible, be in a position to announce, and hopefully everyone will see that as a positive step forward and underpin the future of the business.
And what's likely to be the news flow over the next few months? I think you've got the interims in mid-October.
Yeah, so historically we've released around mid-October the interims up to 31st of July. So yeah, that's in terms of scheduled news flow, that will be the next news flow. We do tend to make announcements from time to time if if anything of note happens. So there could be some ad hoc things in between now and then, but that's the next thing that should be on investors' radars.
Okay. Well, I think, I mean, I'm an investor myself, not an actual shareholder of On The Market. I would strongly recommend anybody to run the slide ruler if they are interested, because I was just running the multiples compared with On The Market, and Rightmove are on around about 20 times sales. On The Market are on less than 3 times sales. You've got Auto Trader on about 14 times sales, and even when Silver Lake bought Zoopla back in 2018, they bought it for 8 times sales. So certainly, if somebody is a serious investor, I would strongly advise them to have a look at the company in detail, and it's certainly got a lot of upside. So thank you very much, Clive, for your time to take us through, and very much looking forward to hearing how the business develops over the rest of the year.
Well, thank you, Paul, and thanks for hosting me, and thank you to everyone who's joined this afternoon.